Well, good morning, everyone. It's really a pleasure to be here. We thank Cesar for putting this together in the Global Chamber. It's an honor to be here to experience the very first Global Chamber event in Puerto Rico. I'd like to maybe begin before I talk about the topic, tell you a little bit about who is speaking to you. My name is Richard Hartmann, and my background is a tax law. I spent 5 years in a national company in the Midwest part of the United States, and then 40 years ago began my own firm, which is a rather unique firm in the sense that we do two things. We are a planning firm, and we do wealth succession and business succession planning. We do not do legal work, and we do not do investment work. So we come up with strategies to transfer wealth multi-generationally. And then to the extent that somebody might have estate taxes or liquidity needs at death, we are part of a national company, international company, that provides very high-end life insurance and very favorable rates for life insurance that might be used to solve liquidity problems, like federal estate taxes in the United States. But we'll talk more about that as we go through. I will give examples from some of my clients, what we have gone through in the past, but that's something we will go through. Again, as in each of the models that we're talking about. With me also is Kristin McGinnis. She has an MBA. She's been working for us for close to 10 years, and in that capacity, she is now in charge of our marketing department, and that's it's actually through her relationship with the Global Chamber that we got here to present to you today. And it's really exciting to see the attorneys, accountants, investment people that are here. As you have questions, we'll probably take them at the end and we'll just go through the material and just note them along the way. But as you notice on that slide, our expertise, it's really planning. We are planning people. As a matter of fact, our name of our company is AUCTORIS. That's a Latin word that really means architects. So we're architects of wealth preservation strategies, ways to transfer money multi-generationally for the protection of family and to the exclusion of taxes to the greatest extent possible. The second example that I gave was our expertise is in the strategic uses of life insurance. Not the normal use, although we can do that, but it's really how can life insurance be used personally within a business? How can it be trust owned, maybe to protect it for future generations? In some instances, we've put life insurance in a trust that's going to be tax-free for perpetuity. It'll never be subject to estate tax or a generation skipping tax, no matter how long family members may live into the future. But today, we're going to spend time talking about growth companies and people who have significant estates and what they can do both here and in the United States to maybe reduce them and reduce taxes, even though I know you have no estate or death or inheritance tax here in Puerto Rico. If any of your clients have assets in the United States, they will be subject to an estate tax. We're going to talk to you about ways that can be reduced from strategies. But before we do, I want to talk about something about the power of M Financial Group. First of all, what is it? M Financial Group is a group of people that came together 40 years ago, and we believe that no one life insurance company had all the answers for people that have a need for liquidity in the future. So we began a company, and to be in this, you had to be an extremely talented, bright, and forward-thinking producer with some life insurance company. And we formed it and said, since no company has products, we then hired an actuary to design products to meet needs of our clients in the future, and took those products then to major life insurance companies like John Hancock and Pacific Life and TIAA CREF and Lincoln, companies like that, nationwide, very, very large companies, and asked them if they would make these products available. But we said, in addition to that, we think we would like you to price them more favorably because our clients live longer than the population as a whole. They're high net worth, they go to better doctors, they take care of themselves, and what we've done is we actually bought a reinsurance company and got actuarially certified numbers each year. And then after a certain number of years, we owned a mortality table for high net worth people. No one has to prove their high net worth. They just get the benefits of our table. But what we found is that our policies are 10 times larger than the industry average. That people that are clients of ours live, actually their mortality is 14% less, so they live 14% longer than the population as a whole. And their policies don't lapse, they don't drop them because they work them and they integrate them into their other planning. So there's a 60% lower dropping of the insurance. You put those three things together and we have lower priced, better performing life insurance products. We also have each of the carriers that are part of our partnership have agreed that as each block of business becomes profitable, they will go back and review it and then share those profits with the policyholders to better their performance of their policy. So we found that as policies are 12, 15, and 18 years old, they are actually about 18 to 20% less in cost than the exact same policy if it were available from that same company through one of the agents of that company. So it is something that our clients benefit from. We have actually challenged the business and changed the industry for the clients that we serve. So now let's talk about federal estate taxes. I know it's a U.S. federal estate tax, but I'm going to talk about how citizens here and residents here in Puerto Rico may be impacted by that tax. We find that very high net worth people in Colombia, in Mexico, in Puerto Rico, even in Ecuador, Brazil, frequently have property in the United States. They'll have real estate owned in the United States, a condominium in Miami, for example. And let's say that that condominium is worth a little over $2 million. For non-U.S. citizens, the first $60,000 passes tax-free, but everything above $60,000 is going to be subject to a United States federal estate tax at 40%. So if someone owns a condominium in Miami or New York, Texas, California, of $2,060,000, they get the $60,000 tax-free. $2 million is subject to an estate tax, and when they pass away, the United States government is going to expect someone to pay $800,000 or 40% in federal estate taxes. It's really not well known, but that's how it is. And if a family is not prepared, it's going to take a significant, again, block of liquidity to do that. There is some planning that can be done maybe before the purchase of a piece of real estate to have it owned in an LLC, so it may not be subject to an estate tax. But again, for those who have it already, we've talked to many attorneys and we all seem to agree that the simplest way to preserve this asset for the family is to acquire an $800,000 life insurance policy on mother and father, or mother or father, either way, and have it owned by a trust in the United States. The premiums are not considered gifts for gift tax purposes for non-U.S. citizens, so the premiums can be paid by a contribution to that trust. And when death occurs, $800,000 pours into the trust, and that $800,000 can be used in an indirect process to pay the estate taxes on the real estate, and it stays in the family. So then for federal estate taxes for U.S. mainland citizens residing in Puerto Rico or any other location in the world, outside or inside the United States, there's a death tax. Now let's look at for a U.S. citizen for assets wherever they may have them. So the gross asset includes your worldwide assets for a U.S. citizen, exempt from tax. Now through 2025 is $11.2 million per person, or $22.4 million per couple. After 2025, it's going to be 5.6 per person if you're single, or $11.2 million for a couple. Anything in excess of that is going to be subject to a 40% estate tax. So you've got a business worth $10 million, a home worth $1 million, United States assets of $15 million, Gross estate is 26, the exemption is 11.2, taxable estate is $14 million, as you can see on the slide, and the tax rate at 40% says you've got about $5.9 or $6 million of estate taxes that have to be paid, again, for mainland citizens who may be residing in Puerto Rico or anywhere else in the country. So the common questions that we get when people learn this, because not many people acquire wealth and say, gee, what should I be doing this, and how big is my estate? They don't think about how fast they want their business to grow regarding estate taxes. People work very hard to increase the value of their business, and then all of a sudden they realize that now they have a successful business, and at the same time they have an estate tax problem. So we meet them generally after the success has occurred. And the questions we get: how do I transfer wealth once I have it? Or more importantly, how do I protect wealth that I built from estate tax confiscation? I mean, 40% tax on a business is very serious, because not many people who own a business have 40% of the value of the business sitting in cash waiting to pay estate taxes. It's a poor use of funds. Thirdly, they ask, is there anything I can do to reduce my taxable estate? When they look at that, they still want control, and of course they still want the income, but they're just saying, is there anything that I can do just to say that my estate is not this large? And lastly, what do my heirs do if my estate is mostly illiquid, a business or real estate, when I die, and they have to solve the tax problem? So those are the common questions we get on our planning side. So let's talk about strategies for shifting value. This is really where we begin our strategic planning with our clients. We never take the place of their attorneys or their accountants, their investment advisors. We supplement the team because we're specialists in this area. I've worked over 40 years with attorneys and accountants throughout the world in coming up with strategies for high net worth families to reduce the size of their estate while they're still alive, but just for estate tax purposes. We still keep the wealth within the family, we just shift it there in different ways. So let's talk about a startup company before growth occurs. Not many people think of planning at that point in time because they perceive that they'll be successful, but they don't necessarily think of themselves as being wildly successful and having a 30, 40, or $50 million estate, but it does happen. So one of the things they could do when they start a company, for example, if we look at companies that they're starting up, we give some percent of the company today a non-voting interest to a trust or family heirs. So you think about that. The first thing you do is you form an LLC for your company. And let's say it's a cryptocurrency company. Well, it's a cryptocurrency company. You have 100% ownership of the LLC. We would suggest that the first thing you do is you take back a 1% voting interest and a 99% non-voting interest in this LLC. Even if it's created, you could just redo it, recapitalize it. The attorney can do that for you. And then you can gift any portion of the non-voting interest away, so no one has any control of your company except you. The percent that is transferred out, is gifted away, will not be subject to an estate tax at your death, and potentially may be estate tax free for all future generations, depending upon if you gift it to your children outright or if you gift it to a trust in the United States. But if you do that in advance when the company is young and not worth very much, then of course, if it's 10 or 20 or 30% of the company you give away, the growth on that percent is totally outside of the estate. Let's take an example. We have a new company worth $1 million today. You exchange your LLC interest to, you take 1,000 of voting and 999,000 of non-voting. You gift 60% of the non-voting to a trust for the family and friends, whoever you may have in mind for your plan. And the value of the non-voting interests is really 35% less than the $999,000. So it's less because you do not have a vote. You don't have a marketability. Who would want to buy a 60% interest for no vote in a privately held company in which you or I may have total control? So you take that $599,400, which is 60% of the non-voting interest. And you take that out to a business valuation specialist, and they would say generally that you're going to get a discount for minority and lack of marketability of about 35%. You may get 37, you may get 40, you might get 42%. So in this case, we assume 35%, so $209,000 comes off the quote value for the gift, and the value of the gift is $389,000. No tax because you're using part of your $11.2 million exemption. So that's how you do it when you set it up. Now let's say the company grows, whether it's been 10, 20 years, 15 years, it makes no difference. If the company is $50 million today, without planning, you'll see on the left-hand side of the slide, you got a $50 million gross estate. The exemption is $5.6 million. Taxable estate is 44. The estate tax is 40%, or $17.76 million. The total family wealth after that is $32 million, but you've lost $17 million to the government. If you did the planning we talked about, the gross estate would be 20 because you gave 60% of the company away to family. So the gross estate is $20 million. The exemption is 5. Taxable estate is 14. The tax rate is 40%, or $5.7 million in taxes. The total family wealth then is $44 million. The benefit by having planned in advance is $12 million, and that's pure cash because it's money that the family does not have to come up with and send off to Uncle Sam. So again, the strategies for shifting value. There's a great benefit in doing that, but again, not many of us would ever foresee that we could start with a company and watch it grow to $50 million and then all of a sudden realize we have a massive estate tax problem. But that's really what happens. So let's take the more likely case like that. We start, we work hard, we're not there to see what we're worth, but all of a sudden we realize we've got a business that's worth $50 million. And that's where we are today. The estate taxes, if we died today, would be about $17.76 million. And you, the client, say to me, well, wait a minute, that's, I mean, I understand that's been successful, but we don't have that in cash. How can we reduce my estate, provide me with cash during my life for my lifestyle, and make sure that I'm in control of this company and can control it as long as I'm alive? Well, there's a strategy for that. This is, I believe, the most powerful strategy with the least amount of risk to transfer immense amounts of wealth out of people's estate to future generations, free of all tax now and all tax in the future. So let's talk about that strategy. The strategy, again, we change if we have a LLC or an S corporation. But if you have an LLC, you change the 100% voting, again, to a 1% voting and 99% non-voting interest today. Then you can gift or sell. And I'm going to take the outside, we're going to transfer as much as possible. We're going to gift and sell the 99% interest of non-voting to a special trust for family heirs. And the sale does not result in any tax on the gain in the value of the company because, as I said, this is a special trust. Suffice it to say, we're just going to call it that. And the reason it's special is because you can sell your assets to that trust for your children. And you are considered selling it to yourself, which means there's no gain to be realized and recognized. So you don't have to pay any capital gains tax because for income tax planning purposes, this special trust says you are the owner for income tax purposes. On the other hand, it's special because once you sell that asset to that trust, you no longer own the asset in your estate, and it's outside of the estate for estate tax purposes. How it's done, that's up for your attorneys and accountants and people to understand, but more importantly, you want to see the results. So let's talk about the value of the interest being gifted or sold. At the bottom of this slide, you'll see that we have 99% of a $50 million company is $49,500,000. You get, again, a 35% discount because it's a minority and lack of marketability because it's non-voting, and you cannot really sell it in the open market because no one gets any say in what's going on in the company. So that 35% discount takes $17.3 million off, and the fair market value of the 99% when you gift it away is $32.1 million. So if you look at the gift, how you're going to make that sale. You're going to say, well, let's gift 10% of that, which is $3.2 million, and we'll sell the balance for an interest-only note at a rate that the government gives us, and today it's about 3.2%. And so if you sell it to a trust for your children. Now, the trust has nothing in it. It is nothing. You set up the trust, there's no value there. And so if you sell it to a trust with no value, the IRS is likely to say, well, how could you sell something worth $32 million to an entity that has no value? So for that reason, the government has given us some examples that are acceptable to them, and they've seemed to imply that if the trust has seed money or seed capital in it or seed assets of 10% of the transaction, that makes the transaction real. And since that number's been given to us essentially by the government, there's no risk in that. So how did we do it? We gifted 10% of the value. Now you can either gift it in value of the stock, or you could gift money in and then use that money to buy 10% of the stock so that you get your cash back. But let's assume it's simple here. You gift 10% in stock, and then you sell the balance for $28 million immediately. What does your estate look like after the transaction? So you've got a 1% interest in this company worth $500,000. You now have a note receivable for $28 million, so your gross estate is $29 million. Your exemption is 5.6. Your taxable estate, the moment after you sign those papers, is 23.8. And your tax is $9 million. Your total family wealth is $40 million, and you've had a tax savings of 46% or $8 million, because on that previous slide you saw the tax for your estate before this transaction was $17 million. So you've reduced your taxable your estate taxes by 46% by a transaction, keeping in mind that you still control the company, you've shifted wealth, and you're going to get income because the income from that company is going to pass through the trust and come out to you as interest payments or payments for the stock, so your cash flow does not change. That's the result. 100% voting. Your cash flow from interest at 3.22% is $1 million a year. You pay income taxes on the taxable income of the company, but that's really considered a tax-free gift to the trust beneficiaries, because 99% of the income from that company now goes to the trust. You're considered the owner of that trust for income tax purposes, so you have to pay the taxes on it. If the company continues to grow, as companies do, 99% of the growth of that company from that day forward is outside of your taxable estate. So your estate is reduced by the income tax you pay on the company income, and your estate tax is reduced by the growth on the 99% that you've transferred out of your estate. So leveraging the strategy, estate taxes are reduced 46% to 9.54%. So the estate tax is essentially frozen because growth occurs in the estate tax-free trust. You own 1%, so 1% of the growth of the company is in your estate, but 99% of the growth is outside. So you've frozen your estate on that asset. If you have other growing assets in your estate, that's great, but those will continue to grow inside your estate. So then the next question comes, is can we leverage down the cost of paying the $10 million remaining estate taxes? Now we've gone from $17 million down to about 9.5, so let's round it to 10 million. Well, let's look at that. There are alternative ways to pay the tax, so let's see. Of the ways to pay the tax, you could pay them in cash if your estate has cash. If it doesn't, your estate would then borrow from the bank. Well, if they borrow from the bank, they're going to have to pay interest, and let's say it's a 10-year borrowing, and they pay interest at 6%. So they're going to have to pay 100% of the tax plus the interest. There's a provision that if your estate owns a significant portion of a business, which you don't anymore because you sold for a note, you could borrow money from the government. But again, you're paying back principal and interest. You could use life insurance. If you own life insurance on your life or your husband and wife together, then life insurance could be acquired in the amount of the expected estate taxes. That life insurance would be owned by a trust, and I guarantee you would never pay, ever. No matter how long you live, you will never pay as much in premiums as the net death benefit that comes to you. So it's really a discounted way to pay the estate taxes. And we'll take an example in just a couple of minutes. Next, if you have liquid assets, stocks and bonds in your estate, the estate could sell the stocks and bonds. And we said that's a 100% plus method because it probably cost at least 2% to sell the stocks and bonds. And if you have to sell in a down market, then then it can be a more significant loss. Another way to pay the estate taxes is if you have illiquid assets. Let's say a piece of raw land. And you'd say, well, we don't need the raw land. Mom and dad were going to maybe develop that. And so we'll just put it on the market. Well, if you have a fire sale for a piece of raw land, that's going to be sold at a very significant discount. It could be 30, 40, even 50% to get the money, because you need the money within 9 months of date of death to pay the estate taxes. The last method is something called a Regan loan. Not many young attorneys today even know about that method, but it was a case, the Regan case, where people were allowed to borrow from a family entity the money and deduct all of the interest they're going to pay over maybe a 10-year period of time against that loan, and they can deduct it from their estate and reduce the estate taxes. But let's skip that. It's a very specialized method. But let's say that we have done that. On the next slide, which you'll have to turn when you actually print this yourself, but on that slide, I took, for example, a client that we have, and we looked at this client here, the numbers that we had proposed in this case here, and we said, okay, how do we pay $10 million in estate taxes when life expectancy is 31 years in the future? We said, because of what we just talked about in this fact situation, Regan loan does not apply, borrowing from the government does not apply, and we assumed that they did not have any illiquid assets. So there are 4 methods for this family, in our example, to pay the estate tax: cash, borrow from a bank after death, buy life insurance today, or sell liquid assets if they have them at death. So if we go out 31 years, we look and you see that yellow line in the middle of the page. We'd say if they have cash, they could pay $10 million. If they borrow from the bank, then they have to pay interest. We assumed at 6% interest, they'd have to be paying about $11.6 million to pay off that $10 million in estate tax. If they acquired life insurance, they would have paid $7 million for the life insurance on a very simple, straightforward, you pay the premiums every year and you die at life expectancy. You pay $7.7 million. And if you had to sell liquid assets at 2% discount, you're going to pay those estate taxes at $10.2 million. Now, if you bring everything back to the top of the page today and you present value everything, well, you pay for cash, it'd be $5.4 million today. Borrowing from the bank is a little over $6 million. Life insurance is about 2.2, and liquid assets is about 5.5. So you find that life insurance is 58% less than the next closest alternative, which is cash. We built this chart and built this spreadsheet many years ago so people could have a discussion on alternative ways to pay the estate tax. And I will just give you some insight. We talk about planning. It may not make sense for this family to spend the $100,000 a year in premium. They may just say, well, we've got other uses for that money. So we might say, fine, why don't we have the company loan the trust the $100,000 a year, and then the trust just pays the interest. And you design the policy so the policy grows. At the first year, it's $10,100,000. Next year, it's $10,200,000. It grows by $100,000 a year, which is equal to the premiums that are paid. So when mother and father die, the total premiums they have paid will be returned by the policy out of excess death benefit, leaving $10 million net to the trust to pay the taxes. Now, the cost for the life insurance there is not the premiums, because the premiums are being loaned by the company, and the trust is going to pay the company back interest at the government rate, and the government rate for that could be 3% or less today. It's generally less than that today. So then you'd have to put a different number in that column, and you could find that, as we did for a 60-year-old woman in the state of Utah, by using that method I just talked about, borrowing money from the family-held company into the trust, that we reduced the cost of paying her estate taxes today, present value, 81% over the next closest alternative. So that tells us that life insurance should be looked at as an alternative to pay the taxes. So now if they did that in this case, we have two strategies. Keep in mind that the first one, we sold the stock to a trust and reduced the estate tax 46%. Secondly, by using life insurance, we reduced the cost of paying the remaining estate taxes 58%. So how much do we save the family? Well, at your death, $8 million was saved on the growth of the 99% of the company. At the children's death, there's another 40% state tax savings on the value of the assets in that trust, because the trust pays no estate taxes. And the savings using life insurance is about $3 million. So the total savings, first generation, is $11.3 million. And essentially, we reduced the estate tax cost from 35.5%, that's really the 40% tax minus the credit. So we reduced the estate tax cost from 35.5% of the wealth to 6.3% of the wealth of the family. Now, that's an example of how powerful the planning strategies are for people that have wealth, that come to us or come to you and say, are there ways to reduce our estate after we built it? And the answer is yes, there are ways. And you'd say, well, this sounds pretty phenomenal. What are the risks again in that? And I will tell you that in this strategy, the risk is in what you take for the discount, for the lack of marketability and the minority interest. And that is about the only risk. Everything else is based upon notes, based upon government examples of what can be done. So you see that there is essentially very little risk in this strategy, but it can be used to transfer millions or hundreds of millions or even billions of dollars of wealth multi-generationally tax-free. Now, to maximize or eliminate tax on gain, you in Puerto Rico have obviously the laws that you're very well aware of, and that's the complying with laws 20 and 22. There's no tax on capital gain if you're a resident of Puerto Rico. As it turns out, as I said, I would use an example. I have a client here who's a resident here, he and his wife. They used to be residents in the United States. They're U.S. citizens. He owns a great number of companies in the United States, but the service company is here. And so as he's built that service company and continued to build it and run it, it now has significant value and is pouring out about $10 million a year in revenue. Because of your Acts 20 and 22, he's able to take that $10 million, being a resident of Puerto Rico, and not paying any tax here or any federal tax in the United States on that income. He is saving $4 million a year by having moved here and becoming a resident of Puerto Rico. Now, at the same time, at some point in the future, he's going to sell that company. And if he sells it after having been here the required number of years, he will pay no capital gains tax on the sale of that company. And essentially, when he came here and started it up, it had a zero basis. So he would have, if it's pulling off $10 million a year, what might it sell for? 20, 30, or $40 million and pay no capital gains tax. That's a 20% savings again, plus the state tax in the United States. So a tremendous benefit that U.S. citizens have by bringing their service companies to Puerto Rico. My client is enamored by those results and very excited. Now, let me tell you how we took his planning and we are doing something even more phenomenal than we just talked about. In his example, he still has to pay United States federal estate taxes on the value of this company in Puerto Rico. because it's an asset owned by a U.S. citizen. He also has to pay estate taxes on all of the companies for which he is providing the services out of Puerto Rico, because he owns those companies in the United States. So let's say his estate is $150 million. So just make it round numbers. His estate taxes are $60 million. He's going to get to reduce the credit. So let's make it a $50 million estate tax. He's looked at it. We've looked at all the alternatives with his attorneys, with his accountants, with his investment people, and concluded without question that the single best way for him to pay estate taxes is utilizing life insurance. Life insurance, you can acquire $10 million for about $116,000 a year. So we said, well, if he pays that, ordinarily he would have to pay income taxes before that premium could be paid. So he set up trust in the United States. Those trusts in the United States own a piece of his companies in the United States, so the trust has income from which to pay the premiums on the life insurance. But they're going to be paid with after income tax dollars. I suggested we might take 5% of his company in Puerto Rico, perhaps put it into a trust in the United States, and it's again a special trust. He is considered the owner of that trust for income tax purposes. So as that trust gets $500,000 of income distributions from the company, he is considered the grantor or the owner for income tax purposes, so he pays no income taxes, and therefore the trust for which he is considered the owner for income tax purposes pays no tax, and he can now pay the premiums for the life insurance for the $50 million at $500,000 a year with income tax-free dollars, gift tax-free dollars, estate tax-free dollars, and we also have another tax in the United States called a generation skipping tax-free. So that is by using the power of what you have created for United States citizens who become residents in Puerto Rico. I think that not only do they have the ability to build incredible wealth here and in the United States, but they also have a strategy where they can use that tool to fund the solution to the problems they have because of their success back on the mainland of the United States. Very powerful tool to do that. Then if you do qualify for 2022 and you take the money, so then the question is, can you defer or eliminate the tax on the gain from the sale of the company? Because if you don't get a total tax-free, like my client hasn't lived here sufficiently long yet to get all the money out tax-free upon the sale. So we said, well, let's say he sells in the next couple of years and doesn't fully qualify for the full capital gain tax benefit. Well, we said, what if we took that gain in the trust and put it in qualified opportunity fund for qualified opportunity investments in real estate here in Puerto Rico? Then he doesn't have to pay tax on that gain outside of the company. You can find a lot of qualified opportunity funds and reinvest those assets, and then the trust doesn't have to pay the 20% tax on the sale of the assets or the sale of the company itself. So you have created here for something that U.S. citizens cannot really get without going outside into other tax jurisdictions, making their life very complicated, having to disclose a significant amount back to other countries and back to the United States. So it makes it so easy for so many wealthy citizens in the United States. And I think the more that their advisors hear about this strategy, the more that you will see it being used in the future. So now, let's talk about U.S. real estate owned by Puerto Rican citizens. We talked about that before. Here's the condominium in Miami, $2 million. The United States estate tax, $800,000. We talked about the options. You could redo planning and transfer that to an entity, or you could acquire $800,000 to $1 million of life insurance personally owned. If you look at that, the outlay for a male age 55 for $1 million of insurance is $10,000 a year. Do you think it is worth it to go and try to recreate or structure a totally different structure to own that piece of real estate? or for $10,000 a year to acquire $1 million of life insurance owned by the family or in a trust in the United States. They get the money, they can pay the estate tax and move forward and continue to retain that piece of real estate, the condominium that was owned by mother and father. Now, another more simple use of life insurance. This is a very, very, very popular strategy in the United States for younger people. Those that are professionals making significant incomes, husband and wife may be both working, they'd like to put some more money away for their retirement. They'd like it to be secure. So they're going to choose something like a fixed income asset. They want it to grow tax-free, and they'd like to be able to withdraw it tax-free. So this happened to me when I represented the president of a securities funds stock analytics company. You may know of the Russell 2000, the Russell 3000 company. Well, the Russell company, the president, I worked with him on the strategy for planning his estate. Again, all of his documents were prepared by his own counsel. We just structured the ideas and ways in which he could reduce his taxable estate. When we got all through, he said, "Richard, I'd like you to do one more thing." He said, "You've solved every problem I've addressed to you." And he said, "I'd like you to find," he said, "I know stocks because our company specializes in that, but I'd like you to do something with something equivalent to fixed income that has these characteristics." You might remember, if you could do something like this, I said to him, "Sir, if I have an idea that solves this problem, you can get in your yacht and you can get in line behind the other yachts that are tied up on my private island as I'm serving their needs." Because I said, "I don't think there's a possible solution for that." And he said, "No, go away and think about it. You solved all the problems." Well, as it turns out, on the plane the way back to Denver, I was thinking about real estate, gold, annuities, special securities. Nothing worked to do what he wanted it to do. And then I said, life insurance grows tax-free, and you can pull money out of a life insurance policy tax-free, but how do you make it efficient? And then there weren't as many opportunities as there are today. This was quite a few years ago. And now this is a mainstay of life for a lot of people in the life insurance industry in solving problems for their clients. So what I did is I said, let's see how much money we can put into a life insurance policy. In other words, increase the premiums as much as possible and decrease the death benefit, because he didn't want a lot of death benefit. He wanted the shell. He wanted the life insurance shell, because whatever money he puts in there grows tax-free. And then he can pull it out tax-free. But he said, I don't really want the death benefit because that takes mortality charges away. So I looked at it. I said, life insurance product, cash grows tax-free. Let's minimize the death benefit and mortality expenses. Let's maximize the premium. Show him how much he can withdraw, because you can withdraw from that policy tax-free everything that you've put into it, tax-free. And then there's still cash in that policy. If you want more money, then you can borrow from the policy, but it is not considered a loan on your financial statement. When you borrow against the cash value of the life insurance, generally accepted accounting principles say you do not show that as a loan on your financial statement. You show the net cash value as an asset. So let's keep the minimum policy until death. And life insurance companies now have a rider on policies like this that you can never pull money out of the policy, so much so that the policy lapses. So there's always a net death benefit that's going to come tax-free. And if you have that, then you make sure that no one ever pays any tax on the growth, and they don't pay any tax on the loan. So let's take a look at it. Again, as you print this slide, you'll see this, but I took someone that was 35 years of age, and I said they're going to pay premiums out to age 60, and they're going to put money away at the rate of about $50,000 a year, and they decide they want to put this in, whether it's a single individual or married couple, but this is a single male, I believe, putting $50,000 a year away into this plan. So the net death benefit, because he's so young, it does buy $1,500,000 of death benefit. If he doesn't want it, we can name it for his friends, enemies, charity, parents, siblings, nieces and nephews for a college fund if he does happen to die at an early age, but that's not generally expected. So you can see the cash values, they're growing out in that at the second last column. Well, when the person gets to 60, he said, I'm going to retire early. How much can I pull out of this policy? And you see that they can pull out of the policy over $200,000, $232,000 tax-free for 20 years. Between 60 and 80 years of age, they can pull out almost $250,000 of that policy tax-free, with the assumptions that the policy is going to grow, what we assumed here, and we were very conservative in our assumptions. As you pull money out of that policy, the policy death benefit decreases because we didn't buy it for death benefit purposes. But what a tremendous tool for people that are young, up to middle age, that want to put money away. You can still do this at 50. It makes great sense at 50 years of age. You can probably put more money away. It's maybe at that time your children are about through a school, about through draining mom and dad. And so you take all the money you were paying in tuition and put it into a policy like this, and it grows tax-free. So no matter where in the world you are, you can pull money out tax-free at death. Do you have to do it over a stream of payments like that? No, you do not. You can, let's say you love to ski. You live down here in Puerto Rico, so you have ideal weather year-round, and you'd like to, as you now slow down work at 59, you'd say, I think let's buy a place up in Beaver Creek or Vail or Aspen, Copper Mountain. Let's go to Denver, Colorado, and look around the places, and we'd like to buy a condo up there for summertime, when it's a little bit cooler up in the mountains. It's probably only 75 to 80 degrees, just gorgeous up there. And you could pull a lump sum out of this and go up and buy that property. And then if you need some other lump sum, some other time, you can pull it out. It's your money to do it as you please. No questions it has to be asked of anyone. You do not need any collateral. They're your money, and it comes out tax-free at any time. So to recap what we've talked about today, first of all, planning can reduce taxes. It's unbelievable when you look at it. Planning can reduce taxes. It can reduce taxes if you plan before you get the wealth, or it can reduce taxes after you have the wealth, but before you die, by going to competent counsel and saying, what can I do? Secondly, after you've reduced your estate for estate tax purposes, we find that life insurance, properly designed, properly owned, and properly paid for, can significantly reduce the cost of paying those taxes. So it becomes a second discount against what is going to the government. And third, and the conclusion is that family wealth can be preserved, because most of the wealthy clients we serve have family-held businesses. Yes, they may sell them or have sold them, but during their working years, and maybe even to the next generation as the children take over that business, they're trying to preserve the business, which is which is really the goose that's laying that golden egg. So they don't see it as money, they see it as a business. And how do you preserve it? Through the planning we talked about, and family wealth is preserved. So at this point, we'll take questions from everyone. We want to thank you. We want to thank Cesar. And we want to thank the Global Chamber. If you are not familiar with the Global Chamber, you might just listen. We got introduced to them through Kristin, as I said, and myself, but then Kristin serves on the board of the Chamber in Denver. And we didn't know a lot about what the Global Chamber did, and so we decided to go down, and we went and visited with them as we were just ready to join, and we said, well, tell us what this might do for us. And they said, well, who would you like to meet and where? And we told them, and they said, okay, we'll arrange for you to meet people or meet businesses or meet professionals in your area of interest. And within a week or two, we were meeting people in those categories. I had not really been aware of the power of an organization like that. So if you don't know much about it, I would suggest you talk to Cesar, because it is a tremendous network of where you can meet people in your profession, related to your profession, or if you're trying to grow your business, where you can meet people. If you identify for them what you're looking for, they seem to have an incredible network where they can put everybody in touch. So again, I thank you. If you have questions, you can ask them as we follow up here, or you can always email or call. As a last commitment of professional courtesy, I always do this in saying I understand life insurance is a very unique asset. It's a unique planning strategy, and it's sometimes very complicated because it has its own set of jargon. So if you ever have a question on life insurance that you run into that's in force, or wondering if life insurance could be used as a strategy, please call us. You don't think you have to use us and involve us in the case. Just call us. We are really a free resource to any professional that has ever heard us speak. We have helped a number of them in situations that they thought were impossible, but together we found solutions for either saving policies that were old or maybe replacing them before they lapsed. A lot of opportunities. You've got my information on the outline. Again, I thank you for attention. It's been a great honor. Cesar, thank you. Thank you all in attendance. Have a great day, and we hope to see you again in the near future.